The worst investing mistake in 2026 won't be picking bad stocks. It'll be falling for dividends that destroy your wealth while looking amazing on paper. I'm revealing monthly dividend funds promising double-digit yields that'll leave you with less money than a boring 3% fund would have given you 5 years down the road. Here's a wild example. One high-yield ETF got crushed by its lower-paying competitor by more than 140% over just 5 years. That's the dividend illusion in action. You're cashing checks, but watching your wealth evaporate. But there's a better way. Today, I'm sharing the only 5 monthly dividend ETFs worth your attention in 2026. These aren't your typical income plays. They've survived my triple income filter, a framework that exposes yield traps and reveals only the funds that deliver income, appreciation, and crash resistance. One of these delivered 19% returns while distributing a 14% yield. Sounds like fantasy? Stay with me, I'll show you the mechanics. Plus, I'll give you 3 ready-to-use portfolio blueprints at the end, customized for whether you're wealth building in your 30s, finding balance in your 40s, or prioritizing cash flow in your 50s. Let's dive in. The triple income filter explained. Before we explore these 5 ETFs, let me walk you through my selection system. I call it the triple income filter. It's designed to separate legitimate opportunities from wealth destroyers. It's anchored by 3 essential criteria. Skip even one and you're gambling with years of potential losses. Filter number 1, the growth engine. This examines the 5-year CAGR, compound annual growth rate, because high yields are worthless if your investment shrinks. We need ETFs that generate returns, not just distributions. Filter number 2, cash flow consistency. This goes deeper than yield percentages. It's about payment reliability and stability month after month. Have distributions been slashed during market stress? Most high-yield funds collapse here. They advertise impressive numbers, but payments fluctuate wildly or vanish entirely. Filter number 3, downside protection. How does the ETF perform when markets tumble? We analyze drawdowns, volatility metrics, and portfolio design. If your income investment craters every market correction, you're not generating income, you're generating anxiety. These 3 filters protect you from costly mistakes. Follow this system and you'll sidestep 90% of the mediocre options flooding the market. Now let's examine the first ETF that cleared all 3 hurdles. ETF number 1, JP, the Blue Chip Income Generator. Meet JP, the JP Morgan Equity Premium Income ETF. I call it the Blue Chip Income Generator, and here's what sets it apart. JP holds major S&P 500 names: Microsoft, Nvidia, Alphabet, Meta. The twist is that JP Morgan employs a covered call overlay strategy. They write calls on portions of the portfolio to create monthly cash flow. That's how they fund distributions, not through stock dividends alone, but by actively generating income via options premiums. JP yields approximately 8.35% and has produced a 9.5% annual return over 5 years. That combination is exceptional for a monthly income fund. It also sports a beta of 0.57, significantly less volatile than the broader S&P 500. Here's the calculation. Invest $10,000 in JP, you're collecting roughly $835 annually. Reinvest those distributions over a decade at 9.5% growth, and that initial $10,000 expands to approximately $24,782, income with appreciation intact. The cost? A 0.35% expense ratio, higher than passive funds, but you're compensating for active management and downside cushioning. Also note, those option premiums face ordinary income tax rates, not qualified dividend treatment. JP satisfies all 3 filter requirements.
Next is an ETF that doesn't chase attention with flashy yields. It dominates through total returns. That's SCHD, the Schwab U.S. Dividend Equity ETF, which I call the Dividend Aristocrat. SCHD's distinction lies in its approach. It tracks 100 premium dividend growth stocks from the Dow Jones U.S. Dividend 100 Index, companies maintaining 10+ years of consistent payments and robust fundamentals. We're talking energy powerhouses, consumer staples, healthcare leaders, businesses that don't just pay dividends, they increase them annually. SCHD yields around 3.8–3.9%, which might seem unimpressive to yield hunters, but watch what happens next. SCHD has compounded at 12.2% annually since inception, outperforming most high-yield ETFs and many growth funds. And it charges only 0.06% in expenses. Break it down. $10,000 in SCHD generates roughly $390 yearly. Reinvest those dividends over 20 years at 12% growth, and that $10,000 becomes approximately $96,463. That's the compounding power of quality dividend growers. The caveat: SCHD's 2025 year-to-date performance has been softer, around 0.9% total return. But that's temporary noise. Long-term, this fund rewards investors following a DRIP strategy, dividend reinvestment plans, where every dollar cycles back to purchase additional shares. Stay tuned. ETF number 3 delivers a 19% return while paying a 14% yield. Too good to be real? I'll reveal how it works. ETF number 3, QQQI, the Tech Growth Income Play. This is the newest addition to our list, and it's generating serious buzz. Meet QQQI, the NEOS NASDAQ 100 High Income ETF. I call it the Tech Growth Income Play. QQQI launched in January 2024, so there's no extensive track record yet. But check out what it does have. Since inception, it's posted a 19.7% annual return while distributing a 14% yield. Let that sink in. 19.7% growth paired with 14% yield. It even claimed the 2025 ETF.com award for Best New Active ETF. How's this possible? QQQI owns the NASDAQ 100. You get tech giants like Nvidia, Apple, Microsoft, Meta. But unlike most income ETFs that sell at the money-covered calls, QQQI sells out of the money calls. This preserves more upside potential while still generating substantial monthly income. Another advantage: much of QQQI's distributions qualify as return of capital, creating better tax efficiency than funds paying ordinary income. That's valuable in taxable accounts. Run the numbers. $10,000 in QQQI produces around $1,400 yearly. Assume 15% total returns over 10 years, and that $10,000 expands to roughly $40,455. The trade-off: a 0.68% expense ratio, on the higher end. And since it's so new, we haven't witnessed its performance through a complete market cycle or sustained downturn. But if you're in your 30s or 40s wanting to reinvest dividends for long-term appreciation while collecting monthly payments, QQQI deserves serious consideration. ETF number 4, Divo, the Stability Champion. Now, let's discuss a fund that skips the flash because it's engineered for one purpose: reliable growth with steady income. That's Divo, the Amplify CWP Enhanced Dividend Income ETF. I call it the Stability Champion. Divo concentrates on dividend aristocrats and blue-chip companies: McDonald's, Johnson & Johnson, Home Depot. These businesses have decades of dividend growth and the financial strength to maintain payments through bull and bear markets. But Divo goes further. It enhances income through selective covered call writing on portions of its holdings. This produces monthly distributions yielding typically 5–6% while maintaining room for capital gains. Over 5 years, Divo delivered 44.42% total return compared to SCHD's 32.63%. That's 12% outperformance while paying higher income. The math: $10,000 in Divo generates approximately $550 annually. Over 10 years at 8% growth, that $10,000 becomes roughly $21,589. Divo also excels at downside protection, lower volatility than the S&P 500, with smaller drawdowns during turbulent periods. The 0.56% expense ratio is reasonable given the active management and options overlay. On our triple income filter, Divo scores solidly across all categories: decent growth engine, consistent cash flow, excellent durability. Before we hit ETF number 5, stay with me. I'm about to compare all 5 ETFs side by side across yield, growth, fees, and tax treatment. You need to see this. ETF number 5, QYLD, the High Yield Cash Machine. Finally, let's cover a fund built for one goal: maximum monthly income. That's QYLD, the Global X NASDAQ 100 covered call ETF. I call it the high-yield cash machine. Here's the mechanism. QYLD owns the NASDAQ 100 like any tech index fund, but every month it sells at-the-money covered calls on the entire index. The premiums collected get distributed to shareholders, creating consistent high-yield income that rarely fluctuates. QYLD currently yields 10.84 to 11.9% and has maintained monthly distributions for over 12 years. This income doesn't depend on company dividends. It's generated through the call option strategy, so even during price declines, income can remain robust. The numbers, $10,000 in QYLD produces around $1,100 to $1,190 yearly. Over 10 years with 6.8% annualized returns, that $10,000 grows to roughly $19,348. Here's the significant trade-off. QYLD caps your upside. By selling at-the-money calls, you forfeit most gains during strong rallies. Over 5 years, QYLD's total return was around 6.8%, trailing SCHD, JEPI, and DIVO. But understand this, QYLD isn't designed to beat markets. It's designed for investors wanting predictable, front-loaded income from blue-chip tech without timing markets or chasing volatile sectors. Perfect for early retirees, conservative investors, or anyone building stable cash flow systems. On the triple income filter, QYLD nails cash flow consistency, scores solid on downside protection, but ranks lower on the growth engine. Like JEPI, distributions face ordinary income tax rates, not qualified dividend treatment.
Side-by-side comparison. Let's stack these ETFs together and analyze the real differences, because on the surface, they all look appealing. But this is where investors make critical errors. They chase the highest yield and ignore everything else. The reality, high yields are meaningless without real growth, low costs, and downside protection backing them up. Let's examine the data. CAGR, Compound Annual Growth Rate. SCHD and QQQI lead here. SCHD has compounded over 12% annually, QQQI at 19.7% since launch. Meanwhile, QYLD's long-term growth is flat to negative in real terms, a hidden cost that compounds over time. Yield, actual monthly income. QQQI and QYLD dominate with double-digit yields. DIVO sits in a sweet zone around 5 to 6%. SCHD offers the lowest yield at 3 to 4%, but compensates with growth. Expense ratio, ownership cost. SCHD wins at just 0.06%. JEPI, DIVO, QYLD, and QQQI range from 0.35% to 0.68%. Higher fees can justify themselves when driving superior results. That's where active management and options overlays prove their worth. Downside protection, drawdown performance. DIVO and JEPI excel with lower volatility and smaller drawdowns. QYLD holds steady due to diversification across 100 tech stocks. QQQI shows more volatility from tech concentration, but returns have justified the ride. Tax treatment, the silent wealth killer. In taxable accounts, income type matters enormously. JEPI and QYLD trigger ordinary income, higher taxes. SCHD and DIVO often pay qualified dividends, a win for long-term holders. QQQI's return of capital structure makes it the most tax-efficient option. The conclusion is clear. Don't let yield blind you. Total return, stability, and tax impact matter equally, if not more. 3 ready-to-copy portfolios. Now that we've dissected the ETFs, let's build practical portfolios you can implement immediately. Whether you're in your 30s building wealth, your 40s transitioning toward cash flow, or your 50s planning the freedom phase, there's a blueprint for you. Portfolio number 1, the builder. Goal: reinvest every distribution for maximum long-term appreciation. Allocation: 40% SCHD, 30% QQQI, 30% JEPI. Why it works: every distribution gets reinvested. Over 15 years, $10,000 here could expand to over $42,000, assuming historical growth rates continue. Portfolio number 2, the balancer. Goal: balance monthly income now with compounding later. Allocation: 30% SCHD, 25% JEPI, 25% DIVO, 20% QQQI. Why it works: half the portfolio delivers high monthly income, the other half keeps future wealth growing. On $10,000, you'd see around $850 to $900 yearly in income, with appreciation working behind the scenes. Portfolio number 3, the income machine. Goal: maximize monthly income while limiting volatility. Allocation: 40% QILD, 30% QQQI, 30% DEVO. Why it works: this combination delivers over $1,000 to $1,200 annually in monthly income with reasonable downside protection. Ideal for early retirees or conservative investors wanting dependable cash flow. These aren't theoretical constructs, they're battle-tested combinations designed to match your goals, risk tolerance, and life stage. If this video added value, smash that like button. Subscribe for more straightforward, hype-free investing content. And if you want proven strategies for building wealth in 2026, check out the video on your screen next. One final note: I'm not a financial advisor, and this isn't financial advice. I'm sharing my research and perspective to help you learn and think critically about dividend investing. Every strategy carries risks, and everyone's financial situation differs. Do your own research and consider consulting with a qualified financial professional before making investment decisions.